$5,100.
It's a number that really makes you do a double take, doesn't it?
It makes me want to go check my jewelry box, to be honest.
Hmm.
We are talking about gold, of course.
Yeah.
It has just completely shattered the ceiling, trading over 5,100 an ounce here in, January 2026.
Hmm.
And usually, when I see a number like that, my first thought is just inflation. But looking at the research you brought today, this doesn't feel like a simple inflation story.
No, not at all.
This feels like a siren.
It is absolutely a signal flare. When an asset like gold goes parabolic, and I mean, truly vertical like this, it's rarely just about economics. It's not just supply and demand.
It's about psychology.
It is. It's the world screaming that it's uncomfortable with the status quo. It's a vote of no confidence in stability.
And that's really the mission for this deep dive, isn't it? We're not just reading ticker symbols today. We're trying to map out a world that feels like it's in flux.
That's a great way to put it.
We've got the financial signal gold. We have a physical signal, this historic winter freeze that is literally breaking the energy grid. And then there's a corporate signal, these massive shifts in who owns our media and, even the mines we rely on.
And if you want to do a vibe check for January 2026, I'd say the word isn't just volatility, it's interconnection. We're going to see how a cold snap in Virginia is actually changing the economics of artificial intelligence and how federal agents in Minnesota are forcing the hand of Fortune 500 CEOs.
It feels like everything is colliding at once, the digital world, the physical world, and then geopolitical world.
Exactly. So the promise is this. By the time we wrap up, you are going to understand why the U.S. government has suddenly decided to become a mine owner and why Netflix is sitting on an $83 billion war chest.
And crucially, whether we actually have enough electricity to keep the lights on and run the AI chatbots we've all become, a little addicted to.
That's the one.
Okay, so let's start with the money, the safe haven scramble. Gold at 5,100. You called it a perfect storm in your notes, so break that down for us.
Okay, so it's like a three-front war driving the price up.
Three fronts?
Yeah. First, you've got the currency angle. The U.S. dollar has gone soft. I mean, we just saw the greenback post its worst week since May.
Right. So when the dollar gets cheaper, gold gets more expensive. Just the math.
That's the math part. But math alone doesn't explain a spike like this, a vertical move.
So what's the second factor?
The second is the big money, central banks. They are buying hand over fist.
Yeah.
And they're not just diversifying portfolios, they are hoarding hard assets.
And the third, I'm guessing, is fear.
It's the geopolitical fear factor. Tensions are boiling over, and when investors get truly scared, they don't buy tech stocks. They buy things they can hold.
It's the ultimate fear gauge. I noticed miners like Newmont, that's ticker NEM, are getting a lot of attention this week.
Of course. That's the leverage play. If gold goes up 10%, a miner's profits might jump 50% because their costs, to dig it out of the ground stay pretty much fixed.
So NEM is getting huge attention. And I saw the SPDR gold shares, GLD, is rallying hard.
But here's what tells me this is a broad flight to safety, not just a weird gold quirk.
Silver.
Silver, the poor man's gold, as they say. It's spiking in volatile Asian trading. That tells you this is global. It's a scramble for anything you can physically touch.
Well, let's go back to the dollar for a second. You said it's weakening. I saw the Invesco DB US dollar index bullish fund took a big hit. Why is the dollar losing its muscle right now?
It's the obsession of the week. The Federal Reserve, the entire market is playing this high-stakes guessing game of will they or won't they with interest rates.
And the bet right now is that they'll pause, or maybe even cut.
The prevailing bet is a pause, yes, that they might pivot. And lower rates usually mean a weaker currency because, investors get less return for holding it.
Yields go down, money flows out. Simple as that.
Precisely. We're seeing the dollar index, the DXY, it's sliding below 98 according to MUFG research. That's a huge psychological floor. But there's an external pressure, too.
Japan,
the yen. Traders suspect the Japanese authorities are about to intervene to prop up the yen. And if the yen gets stronger, that pushes the dollar down even further relative to it. So it's getting squeezed from both sides.
And if the dollar is down and the Fed is getting, dovish, softer on rates, that usually wakes up another sector.
Oh, yeah.
Crypto?
Oh, they are wide awake. I mean, just look at Coinbase, ticker COIN. The whole crypto sector thrives on cheap money. They are watching Chairman Powell's tone so closely.
One guy at a press conference.
Right. If he even hints at a pause, Assets that were considered risky suddenly look very attractive again.
It is just wild. But let's shift from financial friction to political friction, because
Mhm.
it's bleeding into the corporate world in a way that feels different
It
now.
is very different. We have a situation where former President Trump has filed a lawsuit directly against JPMorgan Chase and Jamie Dimon.
This is about the account closures from back in 2021, right?
Correct. Now, the bank has flatly stated the suit has no merit. And usually, this would just be legal noise in the background. But in this environment, it adds a whole other layer of political risk to banking.
It feeds that narrative that banking isn't neutral plumbing anymore. It's a political battlefield.
Exactly. And speaking of battlefields, let's talk about Minnesota. The reports coming out of there about the protests after the federal agent shootings are intense.
They are. But what really caught my eye wasn't just the protests, it was the C-suite response.
This is a critical evolution. This is what we call stakeholder capitalism in action. You have Target and you have United Health Group, both massive companies headquartered right there in Minnesota.
And they are not staying silent.
Not at all. They've joined over 60 other organizations calling for immediate de-escalation.
And the National Basketball Players Association is weighing in too.
Right. But when Target and United Health, huge, generally conservative corporate giants, when they weigh in on federal law enforcement actions, that tells you something important.
That social unrest is no longer just a civic issue. It's a bottom line issue.
That's it. You can't sell goods or insurance if the streets are in chaos. Stability is a premium asset. It's a clear signal that these leaders feel they have to be active participants in maintaining civil peace.
The cost of silence is just too high.
Way too high.
So, okay, we've got gold spiking, the dollar sliding, corporations stepping into social politics. That's the financial and social landscape. Now I want to move to the physical one, because while the markets are heating up, the actual country is freezing.
Freezing might be an understatement. This Arctic blast is just a brutal, brutal reality check for our infrastructure.
I was reading about the industrial impact. It's not just about turning up your home thermostat. ExxonMobil had to shut down refining units in Baytown.
And that matters a lot. Refineries are these complex beasts. You don't just flick a switch to turn them back on. It can take days, even weeks.
And that cascades.
It cascades. Chemical plants, chip manufacturers, they're all curtailing activity. When the weather gets this extreme, the industrial heart of the country it skips a beat.
And for the regular person, that hits the wallet immediately. Natural gas prices jumped 60%. 60 in just a few days.
It's massive. And producers like EQT are seeing huge volatility. Analysts are already warning this isn't a one-week spike. These prices are going to trickle down to your utility bills for months to come.
What about the grid itself? PJM, the operator for a huge chunk of the East and Midwest, I mean, they sounded pretty desperate in these reports.
They were. They had to tap into oil-fired generation just to avoid blackouts.
Oil-fired. That feels like something from the 1970s.
It's the backup to the backup. It's dirty, it's expensive, it's inefficient. But when demand is this high, you burn whatever you have to. It just shows you how thin the margin for error really is.
And down in Houston, CenterPoint Energy was also warning of outages.
They were. They projected maybe 100 to 200,000 people losing power. But surprisingly, they held up okay. Over 99% service reliability.
That's pretty good.
It is. They even released 500 contract workers to go help other states. So there is some resilience. But the system as a whole is redlining.
Okay, and this brings us to the part that I found most fascinating, the aha moment. We always think of cold weather spiking prices because of our heaters. But there's this new player in town sucking up electricity, and it doesn't care if it's hot or cold.
You're looking at the Dominion Energy Report from Virginia.
I am. Dominion saw prices spike, but they flagged a specific culprit for amplifying the demand: data centers.
Specifically, AI-driven data center load. This is the connection everyone needs to pay attention to.
Northern Virginia is basically the data center capital of the world, right?
It is. Something like 70% of the world's internet traffic flows through there. So when a winter storm hits, sure, residential heating demand goes up. That's normal. But now you have this massive unyielding block of demand from AI.
Because everyone is still using ChatGPT, businesses are still running their models, the algorithms never sleep.
Exactly. An aluminum smelter might shut down during a price spike. A factory might shift its production. But you don't just turn off the internet. You don't pause the AI revolution because it started snowing.
So we are essentially competing for power with our own artificial intelligence during an emergency.
That is the conflict. AI is incredibly energy intensive,
Yeah.
far more than a simple Google search. And this load is constant, so it raises what we call the base load demand.
The Dominion case is a warning sign.
It's a huge warning sign. Our digital hunger is starting to clash with our physical survival needs during extreme weather. We're hitting the limits of physics.
That's a terrifying thought. Let's put a pin in that because I want to come back to it. We talked about the government struggling with the grid, but in another sector, the government is getting really aggressive. Let's talk rare earths.
This is a historic shift in U.S. policy.
Yeah.
We are seeing the U.S. government taking an actual equity stake real ownership in a company called USA Rare Earth.
Not just a grant. They are buying in.
They're buying in. It's a package deal. A $1.3 billion loan plus $277 million in funding. The goal is to build a domestic mine-to-magnet supply chain.
Mine to magnet. I like that. Unpack it for me. Why are magnets so important?
Because high-performance magnets are at the heart of all modern technology. They're in the motors of EVs, they're in the turbines of wind farms, they're in the guidance systems of missiles. And right now,
That supply chain is heavily dependent on China.
very heavily. So this is the U.S. government saying, we cannot rely on anyone else for the building blocks of the future. It's economic security, but it's disguised as a business deal.
Speaking of the future in competition, let's look at the software side. We mentioned AI using up all our power. How many people are actually using this stuff daily?
Well, Gallup just put out some numbers. About 12% of U.S. workers use AI every day. A quarter of them use it frequently.
That number feels surprisingly real. It's not just hype anymore.
No, it's moved past the early adopter phase into the early majority. And Alphabet Google is citing their tools as major drivers here. But there's a twist in this that mirrors what we just said about rare earths.
Always a twist.
While the U.S. is spending billions to secure the hardware, Chinese developers are making huge inroads on the software side right here in the U.S.
Really? I thought the narrative was that the U.S. had a massive lead in AI models.
We do, at the very high end. But companies like Alibaba are gaining traction with U.S. enterprise clients. And why?
Let me guess. They're cheaper?
They're fast and cheap. Their open source models are just incredibly efficient. It's a classic disruptor strategy. While everyone is discussing high-level ethics at Davos, Chinese tech is on the ground selling AI that just works and cuts costs.
So we're trying to decouple the hardware supply chain, but the software supply chain is getting more entangled because the code is just a better value.
That's the paradox of the global economy. You can build a fence around a mine. It's a lot harder to build a fence around open source code.
Let's move to the media landscape. Because if you think the energy grid is chaotic, look at Hollywood. Netflix is making a move that is making my head spin.
It's a massive play. Netflix is defending an $83 billion all-cash bid for the Warner Bros. Assets.
$83 billion. In cash, that is just a staggering amount of liquidity.
It shows you the power of their war chest.
Uh-huh.
They want the library, they want the Harry Potter IP, the DC universe, all of it. But it's not a done deal. Politicians are already flagging competition concerns.
And Paramount is still in the mix, right? They have a rival offer.
They have a rival offer on the table, yes. It's a messy, high-stakes battle for the eyeballs of the world. But what's fascinating is Netflix's confidence. Putting that much cash down is a flex. It says, we won the streaming wars, now we're buying the spoils.
It's a huge flex, but it stands in stark contrast to other industries. While Netflix is expanding, other giants are retreating. Look at Volkswagen.
Right, this brings us back to the trade barriers. VW is reassessing its entire expansion in the U.S. They were planning a massive Audi plant. Now they might just shelve it.
Because of tariffs.
Exactly. Higher trade costs just make the math stop working. So while tariffs might protect some domestic jobs, they also discourage foreign investment in manufacturing. It's a double-edged sword.
So mines are opening because of government investment, but car factories are stalling because of government tariffs.
Policy drives geography. It's that simple. Where the money flows depends entirely on the rules the government sets.
And finally, a quick look at retail. The physical world is taking another hit. The San Francisco Center, the old Westfield Mall, is closing early.
It's a sad story, but a familiar one. CBRE was trying to market it, but tenant exits and weak foot traffic just forced their hand. It's another sign that the giant downtown mall, that old way of American commerce, is just fading.
Replaced by the digital delivery systems that need all those data centers.
Which need all that power.
It all connects. The mall closes, so we buy online. We buy online, we need data centers. The data centers need power, which strains the grid during a freeze, and the grid needs renewables built with rare earths, which the government is now buying.
You've just connected all the dots perfectly. It's one single breathing ecosystem.
So let's summarize this wild ride. We started with gold-shattering records at $5,100.
A signal that investors are scared of the dollar, watching the Fed, and just looking for safety in a chaotic world.
We saw the physical world fighting back, a brutal freeze shutting down refineries, spiking gas prices 60%, and showing the fragility of a grid that's being asked to do too much.
Specifically being asked to power our homes and our AI revolution at the same time, leading to that clash in Virginia that I think is the story of the future.
And we saw the U.S. government get into the mining business to secure magnets, while Chinese software companies quietly win market share with cheap code.
And we watched Netflix try to buy the world with cash, while Volkswagen hits the brakes on new factories because of tariffs.
It is a world in flux. It's pulling in two directions at once: expansion and contraction, digital speed and physical drag.
And through it all, that interconnectedness is undeniable. You can't analyze the stock market without looking at the weather report anymore. And you can't look at the weather report without thinking about AI energy use.
Which brings me to our final thought for you, the listener. We saw something happening in Virginia that I think is going to be the defining tension of the next decade.
The clash between digital ambition and physical reality.
Exactly. We are at 12% daily adoption of AI, and that number is only going one way: up. The energy demand is going to skyrocket. So here's the question you need to ask yourself. As our reliance on daily AI grows and as our weather gets more extreme, are we prepared to make a choice? Because in the next crisis, we might actually have to choose between powering our heat or powering our digital intelligence.
That really is the $5,000 question, isn't it?
And on that note, stay warm, stay curious, and we will catch you on the next deep dive.